It does take us to our talk of the tape. Where is the next move for stocks likely to be after that tumultuous end to the week? Let's ask Gabriela Santos, Chief Market Strategist for JPMorgan Asset Management, with me here at Post 9. Welcome back.
Thank you.
All right. What do you think about this market? Because last week was kind of rough, especially the way it ended. Now we have a nice move here into the last hour. Do you think the worst is behind us?
I think there are two separate things going on. The first was the initial macro-driven kind of correction that we saw in stocks that affected a multitude of sectors related to interest rate volatility, related to inflation expectations overshooting, related to the move higher in oil and the dollar. I think early signs that that one's run its course. If you just look at Fed rate expectations for this year, are quite hawkish at this point. And if you look at the performance of the equal weight on Friday, doing a lot better. So that we have more comfort has run quite a long way. But I think this week it's game time for the second bit of the story, which is much more around mega cap technology related to earnings and initial signs that, you know what, great's just not good enough given valuations, positioning and sentiment. And this week will be a key week for that. You
think this was a comeuppance of sorts for the higher for longer idea? Because the market kind of brushed that off for a while. The bond market kind of got there, and stocks have taken a little bit. Is that in part what this is?
I think it's all about the interest rate volatility, because what was interesting is the first quarter yields moved higher, but interest rate volatility actually fell to the lowest since before the Fed started raising rates. And then it just became a positive growth story and perhaps a high for longer, which is okay, can be absorbed by stocks. What changed in April was all of a sudden you had to shoot up in interest rate volatility, and you actually brought back the higher for longer discussion because it became much more about inflation and, oh my goodness, do we need to price in a chance that we go back to actually speaking about rate hikes? And that last bit we think is overdone. The bar is quite high here to actually reintroduce hikes, and we heard that from Chair Powell, and we expect interest rate vol to calm down from here.
What do you think about valuation overall, the market? If valuation was justified before, an elevated valuation, like 20 times, right? If not a little bit higher than that, justified on the idea of good earnings growth, good economy, and rates are going to be coming down. So can we have our cake and eat it too? If now we've pushed out rate cuts, if rates are going to remain higher for longer, can we justify the multiple of the market relative to even earnings growth expectations now coming down? How do we square all that?
Yeah, and I think in the short term, you're really seeing multiple contraction. That's really what's happening here in April. You've had a decline of 6% in the multiple at the same time that earnings have hung in there. And that's just to account for some of these more uncertainties we talked about. But I think if we zoom out, once we have a recovery after what we think is a temporary correction, then yes, I do think valuations can stay elevated as long as it's still a story about a soft landing and high for longer, but not rate hikes coming back and then hard landing fears. But that's where, Scott, really it's beneath the surface in the market. And to us, the major story is the eventual decrease as the year goes on of the earnings growth alpha of Mag 7 versus the rest of the market. And then it becomes not just about a hope of broadening out, but a reality which meets earnings recovery plus more discounted valuations.
Is that kind of what's going on now in some sense, too? A rotation really away from mega cap tech and away from tech in general to some of these other areas. I mentioned financials at one point today were outperforming by a lot. Now the rest of the market's caught up because every sector in the S&P is now green, and it is no longer the financials the best sector on this day. It turns out that it's technology, so you have those dip buyers coming in.
Absolutely. I think for those that had missed out on the rally last year for the Mag 7 or for the S&P 500 overall and were bemoaning that we were back at all-time highs, this is another bite of the apple here to buy into some of these themes. But I think what's more long-lasting here is the dispersion within a group like the Magnificent Seven. Very clearly, you have a lot more dispersion. Not every group is up double digits. You have some down double digits. And we can't forget the importance of thinking through these as very specific individual companies and what weight should they have. And we're not really bought into this idea that it just goes up and to the right and that it's the new defensive. I think if you're looking for defense, it's in your traditional defensive sectors like utilities, which really did quite well last week.